Aloha students, welcome to the lecture on Chapter 1. Chapter 1 is just a basic introduction to managerial accounting and it prepares us for looking at the remaining chapters in the textbook. So you've looked at financial accounting in several of your courses, including Accounting 201 and Accounting 301, 302, Intermediate Accounting if you've taken those. Financial accounting is preparing information to users external to the organization, so outside users of financial information. Managerial accounting, on the other hand, is information and reports that are used by people within the organization, so internal users, so managers of the company. So this course is devoted to looking at managerial accounting, internal reporting for managers. I'm just going to skip over to the key elements that I think you should know after reading the textbook. Okay, so the term decentralized management, as indicated on this slide, is decentralized is decisions are made at the level that people are actually doing the work. So the responsibility is shared, passed downward in an organization chart. So people at the lower levels make decisions and are active in determining what the objectives are. That's that's contrasted with the term top-down or centralized management. That's where all the decisions are made by the people at the top and everything is mandated down to the staff level departments. So lower level employees don't have any decision-making ability and no responsibility for determining the objectives of an organization. Who's who in accounting? People get these two terms confused a lot. The controller is the manager of the accounting department. So the controller is specifically involved with the accounting function. The chief financial officer, on the other hand, handles all financial matters, including accounting, but also finance and various other responsibilities. So the controller reports to the chief financial officer. In smaller organizations, the CFO and the controller may be the same person, so they combine these functions into one position. But in larger organizations, the controller manages the accounting department, the CFO manages the controller and other financially related functions as well. These are the four functions of management: planning, organizing, directing, and controlling. So planning is just like it sounds, it's just figuring out what actions need to be done in the future. So short range and long range planning. So you have to try to anticipate what's going to happen and then what kinds of actions you need to take. Organizing, obviously, is getting people and resources together. Directing is monitoring and then managing people and resources. Controlling is figuring out what to do when plans may not be met, or even if plans are met. Controlling basically means overseeing operational functions. The term management by exception. Management by exception is management concentrates its efforts only on those things that are not what is expected. So if, for example, there's 3 different departments and they're all expected to sell 1,000 units of their product, management will concentrate only on the units that either sold less than the 1,000 or more than the 1,000. But if something is close to what is expected, not much time is spent there. Okay, that's management by exception. So the management focus is on things that are different, significantly different than what is expected. Excuse me, feedback. Obviously, managing a corporation requires feedback from people within and outside of the organization. So you can, that's just terminology that you should be aware of. Decision making, okay, is choosing between alternatives. So making a decision based on different alternatives. Here's a model of the decision process. Kind of interesting, but don't worry too much about this. Okay, so major types of organizations. There's 2 categories, major categories of organizations: for-profit and not-for-profit. The book says profit seeking, but the more common term that's used is for-profit organizations. These are organizations that are in business to make a profit. Okay. There's 3 types of profit-oriented or for-profit companies. Corporations. Corporations are entities that are owned by shareholders, so they sell stock to people, and people who buy the stock of a corporation are its owners. A partnership is an organization that is owned by 2 or more people, and a single proprietorship or sole proprietorship, as it's sometimes called, is a business that's owned by a single individual. So it's like a one-man operation kind of a thing, or owned by one person. In the not-for-profit organization category, you have governmental organizations. So, government-related entities like State of Hawaii, for example, or City and County of Honolulu. Okay, those are not-for-profit governmental organizations. And then the non-governmental organizations are sometimes abbreviated as NGOs. These are typically organizations that you think of as charities. So they're not in the business of trying to make a profit. They're in the business of trying to do good in the world. And profit is not the motive for this kind of organization. In this course, we will be focusing primarily on corporations. We'll touch a little bit on partnerships and sole proprietorships as we go through the course, but primarily we will be focusing on for-profit corporations. Information. Okay, so sources of information. Where do we get information to do our accounting? For financial accounting, the information comes from the recording of transactions and events. So things like the general journal, general ledger, things you learned in financial accounting. In managerial accounting, there's no one single source of data or information for preparing management accounting reports. Notice includes both quantitative, so numerical information, as well as qualitative information, so non-numeric information. So they come from all different sources within the organization. So financial accounting is kind of strictly, narrowly defined as coming from the recording of transactions, management and accounting, that information can come from almost anywhere within the organization. Uses of management accounting information. Again, our functions of management: planning, organizing, directing, controlling. So you can see, and I'll let you read this on your own in the book, there's various ways of planning. So mainly budgeting is the primary method for planning for future periods in management accounting or managerial accounting. Organizing is using resources in the best way. Directing is overseeing operations by using accounting information like costs and sales and profits and that kind of thing. And controlling is after the fact, comparing what actually happened against what we thought or wanted to happen. Okay, so again, controlling is generally after the fact. Okay, so we look at what happened and then we ask, why didn't what actually happened correlate with what we thought should happen? Okay. Differences between management. The book calls this management accounting. The more common term is managerial accounting. Both are synonymous and both are accepted. Okay, so financial accounting, the information is guided by rules of accounting principle. So that's mandated. On the other hand, managerial accounting, there is no specific rules on how you report managerial accounting information. Basically, the reports in managerial accounting are in whatever form management wants it. There's no standard form. There's no specific rules about how you prepare reports, as contrasted with financial accounting, where there are specific rules and the reports are pretty standardized. Balance sheet, income statement, statement of cash flows. Okay, those are all pretty well standardized for all companies. Again, managerial accounting, it's really varies depending on what kind of information management wants. Some other differences: financial accounting is primarily historical. So financial accounting looks at past transactions and accumulates those past transactions into financial statements. Managerial accounting, on the other hand, has a focus more toward looking at the future. So prospective information, so looking forward. Again, financial accounting is past information. Managerial accounting is using information to look into the future or predict the future. This is just a plug for the CMA, Certified Management Accountant. You may be familiar with CPA, Certified Public Accountant. Those are accountants who are certified to mainly audit companies and to be an independent verification. CMA, on the other hand, is a certification for people who work for a specific company, like Ford, for example, or General Motors. And a CMA exam is useful for those who want to specifically work for a company rather than for an auditing firm that does work for many, many companies. Here at Chaminade, we've established an Institute of Management Accountants student chapter just last year, and we are encouraging students to take the CMA exam. One of the reasons is the CMA is easier to pass than the CPA exam. So we're encouraging students to actually attempt to pass both of them, but attempt the CMA exam first because it is easier than the CPA. Oh, and I guess that's the end of the chapter. So, yeah, by the way, my favorite food is sushi. I really like sushi. And one of my bucket list quests is to eat sushi in all 50 states. And I'm about two-thirds probably of the way through that bucket list right now. Okay, that's the lecture for chapter 1.